What if I told you that there were some hidden places where you can borrow money that you may or may not even know about? And that's what I want to go over in today's video. I want to uncover 5 untapped places that you could be borrowing money from. And if you did, it could save you thousands, maybe tens of thousands, and some of you even hundreds of thousands of dollars. So we're going to find out which one of these places suits you best. One of the most important things to understand is that borrowing wisely matters. You know, you've heard that you can have bad debt and good debt, but I would say all debt is, for the most part, bad. It's more how you use debt. That's where the good comes in. And that's one of the most important things we're going to consider with these 5 different places. We're going to briefly cover the importance of these different options, these different untapped options. And the differences are going to be things like interest rate, flexibility, payment terms, and we're going to also talk about the importance of how the interest is charged on that money. And when I go through these, I'm going to cover them from the most familiar, like the loans that you're most familiar with, and we're going to end with one that you probably don't know anything about. And that one is the single most important one. So make sure you stick around to the end. But since we're in the beginning of the video, let's take a second to pause. And all I'm going to ask you to do is click that subscribe button. And right above, there's a little bell. I just need you to smash that bell so you're notified every time we go live or put out a new video. Let's get into it. So the first place is not really an untapped place. It's the place you're all familiar with. It's the traditional bank. How many times have you gone to the traditional bank to borrow money? Probably a few, maybe some of you a lot. You've gone there for your traditional mortgage, you've gone there for your car loans, you've gone there maybe for a line of credit, maybe even a home equity line of credit. We're going to cover some of those in the later topics, but let's just talk about the problems or the pros and cons of a traditional bank. Number one, when you go to a bank, you go there for one of 2 reasons. Number one, to deposit money or to borrow money. So you're either on one side or the other. You have money and you want to make more, or you need money for something, right? So that's what you go to a bank for. But let's just talk about the traditional bank and how it really operates. You go to the bank and you deposit your hard-earned money into the bank. And why do you do that? Well, the first and most important reason why you do this is because that's what you've been told to do. You've literally been conditioned from a young age all the way to where you are today to be taught when you make money, you deposit it in the bank. And then maybe there's been some variations of checking versus savings, high yield savings versus regular savings and all that, but we don't need to get into that. The point of the matter is you've been taught and told to put your money into the bank, and secondarily, you put your money in the bank because, well, maybe the bank pays you interest. How much interest are you getting on your checking account? Probably 0, but how much are you getting on your savings or high yield savings? Well, that's going to range between 1 and about 4% by today's numbers. So that motivates you to keep the money there. But then what do? Well, you go to the bank and you use that to spend. You spend that to pay your bills, your expenses. But the other reason you go to the bank is to borrow money for something. Now, let me just ask you a question. If the bank is paying you, we'll call it 3% on your high yield savings, can you go to that same bank to borrow money at a rate less than the 3% you're earning on your money? No. The answer is always no, because the bank wouldn't make any money. As a matter of fact, the bank would lose money. Now, I'm not counting those intro, teaser rates that they might give you for a month or maybe in some cases 12 months, but that's rare. I'm talking about just off the cuff. You're getting 3. How much are you going to be able to borrow from that bank? It's almost always double, right? So if you're earning 3 on your savings, you're probably borrowing at a minimum of at least 6. Car loans, 6, okay, then you might even be paying more than that. You could be paying double digits at the bank. And in the middle is what the bank makes. It's called a spread or an arbitrage. That's how banks make money, at least the simplest form of how banks make money. But here's the other things that you've witnessed when you've gone to a bank to borrow money. Lots of paperwork, lots of questions, lots of things you need to do. The first thing you always do when you go in to borrow money is you complete an application. And on that application, they ask you a lot of questions, but not just a lot of questions, a lot of financial questions. What is your income? How many income sources do you have? What are your assets? How much money do you have in other banks? How much is in that 401k and that IRA? Where's all your money? It's called a personal financial statement. If you've borrowed money from a bank, you have filled one of these out. And a lot of times banks will actually combine it into their application. But what you're basically telling the bank is you're telling the bank how much money you've got and how much income you have, so the bank is going to be able to underwrite your loan and determine if you default, what are they going after first? And that is in order of priority. And first line on a personal financial and the asset statements is cash in banks. And then they have a schedule so that you can list all the different banks you have money at, because one bank wants all of your assets, although you're probably smart enough not to do that. So outside of all the paperwork and all the stuff, when your loan gets approved, if it gets approved, you are then given an offer, and then you have to read the fine print. What are you signing off on? Well, you're signing to the terms or the note that they're lending you at a certain interest rate for a specific period of time at a certain monthly payment, right? That's what you're signing. But then you're also personally guaranteeing the loan. Unless you're one of the very few that goes non-recourse, but you are probably not, so you are more than likely guaranteeing the loan personally, which then reverts back to that personal financial statement. So nonetheless, all I'm trying to help you understand is that you're never going to make more at a bank in what you earn than what you're going to pay the bank in the form of a loan. So if you borrow from the bank, you're always paying more than what you're earning, so you're losing and the bank is making. Any questions on that? And if you do have questions, put them down in the comments section. But I just wanted to kind of cover that because that's going to transition down through the rest of these different things we're going to talk about. But a traditional bank is always in control. You are always going to be the one that is going to lose in that because the bank is in the business of making the spread. So the second place you can get money, I would call this untapped because this is a place that most people have but don't really use. So what am I talking about? Now first I'm going to start with a story. Let's imagine, I don't know, pick the worst day you ever had at your job, okay? Think about that day. Nothing went right. Every call that came in was bad news and you had to stay late because nothing was able to get done because everything just piled up. So you're finished that day, let's call it 7, 8 o'clock at night. You're walking to your house from your car. It's pouring rain, it's miserable out, it's dark. You get to your front door and you open it. Now just pause. You look into your living room because you can see in there, and right there on your couch is your money. Just envision that. Your money is sitting on your couch, it's watching your TV, you notice it has some popcorn and a soda, it's having a grand old time, and it's doing that, it's been doing that all day because it's been sitting there watching TV while you've been at work experiencing the worst day ever. So you're standing at the door, soaking wet, watching this while your money notices you. It looks over at you with a little grin, it smiles, it waves, and it says, "How was your day?" So how was your day? What I'm telling this story for is that money represents the money that's buried in the walls of your house. They call it equity, but really it's just money that you have locked up in the walls and you have not accessed. That equity almost everybody has right now unless you just bought your house. Why? Because real estate has been appreciating, which means if you bought a house for $200,000, your house might be worth $300,000, $400,000, $500,000, $600,000. This is a common discussion I have with clients where all their money is sitting in the equity in their house. But one of the big problems with the equity in the house is it's not always easy to access. Okay? And that accessibility comes in the form of what we like to call a HELOC, a home equity line of credit. Now, who issues home equity lines of credit? Well, traditional banks, like the ones we just talked about, do. You can get them from credit unions and community banks, but they're all traditional banks that allow you to tap into that lazy money. And we want to do that because that money should never be sitting on your couch eating your potato chips and your popcorn and your soda while you are slaving at work trying to make an income. Your money always should be working for you. So a HELOC is super important. But here's the biggest thing I hear from some people, most people right now. Well, we wanted to get a home equity line of credit, but interest rates are so high, it just doesn't seem like it makes sense. Define high. And then they would say, well, it's 7% or 8%, or not long ago, it was 9% interest to tap into the equity of your house. To that, I always say, okay, what other debts do you have that have a higher interest rate than 9% or 8% or whatever your HELOC is? And they all say, well, we have credit cards that are 20+%. I say, okay, so would it not make sense for you to tap into the equity in your house, to take that money, that equity, and then deploy it, take a loan from the HELOC, which, let me just preface, there are two ways you can set the interest up on a HELOC. Now, write this down. Number one, you can do fixed rate, which I do not recommend, because then it becomes like an amortized loan. And then there is variable rate, which is more simple interest, where the interest rate is going to be set at whatever the prime rate is out there, and it's going to float, it's going to vary. Okay, that's the one you want, because simple interest in what we're going to talk about next is the most important thing. So a lot of people go for the bait. They take the bait of the fixed interest rate because it's lower than the variable. But here's where we're at right now. This is 2025, January to be specific. Interest rates are on the move down. So do you want a variable rate that's going to reset when rates go down, or do you want to lock in a fixed rate just because it's a little cheaper today? I think you're smart enough. Variable. So now we take the loan from the HELOC and we pay off the high interest rate credit cards, which were 20%, let's just say. 20 minus even 9% is a pretty healthy spread, is it not? Yes, 11%. So you are making a spread, just like the bank was, of 11%, even though the bank's charging you a super high interest rate of 9% on that HELOC, to which a lot of people don't do the HELOC because they say, oh, it's too expensive. That's all relative. It's not too expensive when you're paying 20+% on credit cards. Or maybe you got some of those loans that you take out from the furniture store. Or maybe you got a car loan that's more than that. It doesn't matter. All you need to understand is, can you make more than what the cost of capital is, or do you have somewhere or something that you could pay off that would then allow you to make a spread? Think as if you are the bank. That's a HELOC. Now, HELOCs come in lots of shapes and sizes, and I'm not going to go into that here, but this is where we start to enter one of the best untapped borrowing sources that too many people are not taking advantage of because interest rates they think are high. And interest rates are on the move down, so HELOCs are going to get cheaper and cheaper, so you are on the right side of the coin in this one. Anyway, hopefully I didn't bore you with that, but don't let your lazy money sit on the couch while you are off working. Get your lazy, untapped equity out to work for you. And all you need to do is abide by a couple simple rules. Whatever the cost for the capital is, put the money to work at a higher interest rate, and always be very considerate of the risk you are taking to make that return. If you pay off a credit card, zero risk, but if you go out there and you invest it in some speculative investment or put it into the stock market, way too much risk. And trust me, if you told your spouse, your significant other, what you were doing with the equity in your house and you were going to go out and risk it, chances are they're going to be pretty pissed off at you. I know mine would be. All right, let's keep moving on because it's going to get more fun. We are on number 3 of the untapped borrowing sources. And this one is your fancy-dancy retirement account. That's right, your 401k, your 403b, maybe even your 457. If you work for somebody and you have a 401k that they offer to you and you are payroll deducting and putting money into that 401k, you're gonna really love this source. Now, you probably already know you can borrow from your 401k or qualified retirement plan, not to include IRAs, SEPs, simple IRAs. They cannot be borrowed from, but your qualified employer-sponsored retirement plan, most of them, not all, but most of them have a borrowing or a loan provision that allows you to borrow money. So let's go over to the whiteboard. Let me show you how this works because this is cool. All right, so we were talking about qualified retirement plans. That's your 401k, 403b, maybe even your 457. And you might even be confused. If you work for a company, the majority of you have a 401k. If you work for a nonprofit or a school or maybe even a hospital, you might have a 403b because those are nonprofit. And a 457 is for all you government folks, government employees. But all of you have the same awesome opportunity that we're going to go over right now. Number one, while you've worked there, you put money into the qualified retirement plan because, well, you were told to. Yeah, same thing as the bank. You were told to put your money there. That's why you do it. Plus you get a pre-tax deduction and maybe you get a match. But none of that's important here. What we're talking about is, can you use your retirement funds, your money that you've been saving for retirement, before retirement? Well, the answer is, for most of you, yes. You can take a loan. Now, there are lots of rules around loans, and you must check with your plan administrator to make sure your plan even allows for loans. But here are the basic rules. Most plans will allow for up to 50% of your balance or $50,000. Those are the max amounts that you can take from your 401k. Now, I know some of you are like, well, I got $1 million in my 401k and I can only use 50. Yeah, but let's just use what we can use because it will make sense to use this money. Now, first off, in your 401k, you're earning some type of a return. So we gotta factor that in. Now, right now, I will tell you, 2025 is probably gonna be a rocky year for the stock market. It's gonna be up, down. I mean, you got a new president-elect in there. You got lots of new changes and tariffs and all sorts of things which are not going to be good for the markets. So you can expect that the market's probably going to go down. So one of the things you would consider is, how can this money go work for me to make my life better, to put me in a better situation without taking the risk or riding the market down? Well, if you were to take the loan from the 401k of 50, let's just use 50 grand, right? Let's just say you have $50,000 and that is less than 50% of your balance, and you want to take a loan. First thing, you have to check and see if it's available, but if you can take a loan, there is going to be an interest rate they're going to charge, okay? So the plan administrator or your plan is going to charge an interest rate, and what we're seeing right now is right around 8%, okay? So you can basically know that you could borrow your money from your 401k, but it's going to cost you 8%. And your 401k, this is also what you got to figure, is going to then do a payroll deduction, okay? So from your payroll, they're going to take this payment out, okay? So that 8% is going to be taken direct from your payroll. So it's going to hit your payroll. So here's what we must do. Whatever we use the money from your qualified retirement plan for, it's got to earn a higher interest rate than whatever the charge is. We'll come back to that in a second because that's not really true. But it's got to produce a cash flow, an income that's going to be more than what is going to come out of your paycheck. Fair enough? So you got to do a little bit of work on your end, but let me just show you how it works. Let's just say we got 50 grand. What we're going to do is we're going to move that 50 grand from the 401k to somewhere else in your life where you're paying more interest than what they're charging you, okay? Easiest place would be to start with credit cards, because chances are most of you have credit card debt, because if statistics are right, we have a major credit card debt problem in this country. So I would say most people have credit card debt, and most of you that have credit card debt, you are enjoying the fine interest rate they're charging you of probably north of 20%. So if you're paying 20% every month, that means you're making a payment to some credit card, and that payment is mostly interest. Got that? So here's what we're going to do. We're going to take the loan from the 401k. We're going to pay off the credit card. So we no longer owe this payment to the credit card, and we're no longer giving the credit card interest because we just paid it off, but we paid it off with a loan from our 401k. So what I would suggest doing is taking the payment that you used to make to the credit card, dollar for dollar, whatever that is, and what I want you to do is put it back into the 401k to repay that loan, and hopefully it's more than what you are having to come out of your payroll, because now you're making a spread. You're getting to enjoy it. And here's how you can do it. Whatever that difference is between what they're going to deduct from your paycheck and what you're actually, making, what you were paying to them, you get to keep and enjoy that. But even if it was just a wash, right? Let's say what you were given the credit card is the same amount that's going to come out of your paycheck. Who cares? You no longer have the credit card debt, and now you're paying yourself back. Because every dollar that you pay back over here to the 401k is money that you have for your retirement. But now let's talk about the one thing that I love talking about here. So let's just say you did that with your credit card at 20%. It's kind of like recycling and recapturing 20% in interest. You would have had to have made 20% in your investments to equal the same amount you were giving away to the credit card. So this is a win. But then there's that pesky interest rate that they're charging you. The greedy jerks. And some of you would be mad at your boss. You'd be like, my boss is taking that interest. I know he is. He's greedy. Hold on. This is where you're going to really love the rules. You know that 8% interest rate that they charged you to take the loan from your 401k? Who does that 8% get paid to? Yeah, you. That 8% is going back in your 401k. So you're not just recycling and recapturing 20%, it's 20 plus the 8% interest or whatever that interest rate is. The interest that you're paying on the loan is the interest that's going into your account. And you know what the best part is? It's guaranteed. No risk, no market volatility. The 8% or whatever interest rate goes right back into your account, plus all of the interest you were giving away goes back in, plus you got rid of your debt. Heck, why not go through and pay the car off if you've got enough money? Even if the car was 6%, now that you understand this, and I did this intentionally, remember I said if it costs you 8%, you got to make sure you're earning or paying something off at a higher interest rate than 8%, but it really doesn't matter. The 8% is getting paid back to yourself. Therefore, if you had a car loan at 6%, or heck, even let's just say it's 3%, doesn't make a difference. Pay the car loan off, take the payment from the car loan, put it back into the 401k because now it's 8 plus whatever you were paying on the car loan. You see how this makes sense? Because now you get to use your retirement funds before retirement while you're struggling or while you're trying to pay off debts, and you get to do that and you get to make money the whole time. All right, so let's move on to the next one. This one's really popular amongst real estate investors. So the fourth option is private loans. So what is a private loan? Well, it's the opposite of a bank loan. You just go to an individual and you borrow privately from them. Now, I'm just going to use myself. So I am the private lender. So let's just say Chris is my private lender. And over here, let's just say this is you, okay? And you need money for this real estate opportunity that you're looking to buy right here, okay? So this is your real estate deal. You need money. You can't go to the bank because they won't give you money fast enough. You can't get a home equity line of credit because, well, you don't have equity in your house. So you're just like, I don't know where to get money from. I don't know what to do. Well, private loans. So you come to me and you find me on this website called Private Money Club, okay? This is a real thing, privatemoneyclub.com, little shout out here. You can go there and there are thousands of private lenders like myself because we have money and we want our money to go to work for us, but we want it collateralized. We want it protected. So that's what we're talking about. So you come to me with this deal, you show me your full deal, you got your whole package and I approve it. So now how the private loan works is I'm going to lend, but I'm going to be at a higher interest rate. Let's just say I'm going to charge you 15%, which you're not going to like, but the bank would have charged you 8% plus closing costs, all those closing costs. Me as the private lender, I'm going to charge you 15%, but the only thing you're going to have to pay for is number one, the appraisal, because I want to see an appraisal. And number two, the legal fees, which are only about $500, maybe $650, $500 to $650, give or take. So that's what I'm going to charge. I want you to pay for an appraisal, and I want you to pay for my legal costs to do this loan. But now all of a sudden, what I can do is I can distribute the money you need for your house really quickly. Let's say you need $200K. I'm going to charge 15%. I'm going to go in a first lien position. I'm going to issue a mortgage, or actually, I'm not going to issue it. The title company or the attorney is going to put together a mortgage. It's going to be a first lien mortgage, which means I'm in first position. So if you don't pay me, I can go after your house and foreclose on it, and that's going to protect my investment, my loan. So now I distribute this money. It goes to a third-party escrow, okay? And once your ducks are in a row and you're ready to close, the escrow gives you the money, you close on the house, then what you do is you start making those interest payments back to me. That's how private lending works. It's just like a bank loan without all the hurdles, without all the issues, okay? Most private lenders are gonna be educated, so they're gonna know what they're looking for, so you as the borrower need to get prepared, but this is another untapped potential, because who are the private lenders you're looking for? Well, maybe they're on Private Money Club, but maybe it's your grandma, maybe it's your mom and dad, maybe it's your aunts and uncles, maybe it's your coworkers. It can be anybody, because every single person out there is one of two people. Number one, there's somebody that has money and they want to make that money work for them, or somebody like yourself that needs money, if you might even be both. But that would be private lending. So that is another untapped source of money. All right, and the final untapped place, and probably the single greatest place you'll ever learn about, is none other than giant mutually owned insurance companies. Yes, you can borrow from a mutually owned insurance company if and only if you are an owner of the company. Yeah, that's all you gotta do. All you gotta do is become an owner of a giant mutually owned insurance company to borrow from the insurance company. I'm just messing with you. If you are a policyholder of a specially designed and engineered whole life insurance policy, or any whole life insurance policy, guess what you are? Essentially an owner, because they are mutually owned insurance companies. So let's just pretend this. Let's say you changed one thing, and that was where your savings went first. And you move that money into a specially designed and engineered whole life. Now, I'm not gonna go deep into this because I'm gonna put a video up at the end that's gonna fully walk you through this, but I want you to just understand how this works. You then put your money in the specially designed whole life. So in this example, I got somebody putting $75,000 and they're earning 6% interest and dividends on that money. Remember, you put money into a traditional bank because they pay you interest. Well, are any of you getting close to 6%? Well, the mutually owned insurance companies are paying that in form of a dividend crediting rate. Anywhere between 5.5 and 6.4 is what the dividend crediting rates are with the companies we work with. So that's better than a bank account, but here's where it gets really fun. Now, remember we were talking about cars and we were talking about credit cards and all those debts. Let's just pick on a car. Let's say you own a car and your monthly payment's $1,478 a month, and that interest rate is 6%. Okay, let's just use 6% for the number. That isn't so bad, but how many of you would like to pay $1,478 a month back to yourself every month instead of to the bank on that car loan? And if you did that, what if you got to keep the $13,681 in interest you would have paid to a bank on a 6% car loan? You'd like that, wouldn't you? So here's how it works. The downside to this option is you are the bank, which means you would have had to have saved enough money to pay off that car loan. So let's just assume that to pay that car loan off took $75,000. Now, you'd have to have more than $75,000 in cash value in the specially designed whole life. That's the downside, but this is the upside. If you have that cash value, you can borrow it at any time for any reason. And when you borrow the money, the insurance company is going to charge you interest, but right now the interest rate is less than the dividend crediting rate. So remember how when I talked about a traditional bank, you put money in, you get like 3 and then they charge you 6. Let's flip that. Let's say you make 6 and it only cost you 3. That's kind of the relevance here. Now it isn't, those aren't the numbers, but right now, if you're getting a dividend crediting rate from a mutually owned insurance company in the whole life policy of 6, you're probably borrowing it right around 5%, 5.5. So if you take 6 minus 5.5 or 6 minus 5, you now are making the spread. So that's the first part, but it gets way better. Now you pay off the car loan. Okay, so you no longer are paying $1,478 a month to their bank, but what you're gonna do is you're still gonna make that car payment. Now think like the 401k. We're gonna make that $1,478 car payment, but we're gonna make that back to your policy. We're gonna repay the loan you took from the giant mutually owned insurance company at a rate of $1,748 a month, which here's the cool part. That $13,681 is getting paid back to yourself, and you are keeping that money. You're losing no control of your money, okay? But here's the best part, and I left this for last. That 75 grand that we had in there, or a little bit more, when you took that money out as a loan, you didn't take your money. The insurance company, and I said that in the beginning, the insurance company lent you money from their general account, which means all of your money, all of your savings that you changed where it went and you put it into the whole life, that's still earning uninterrupted compounding interest at whatever the dividend crediting rate of your insurance company is. All the while, you got to come over here and pay off some debts and recycle and recapture that 6% you were paying on that car loan, plus all the interest. The $13,681 over the term of that loan is now paid back to yourself. And when you're paying it back to yourself, you're paying the loan down to the insurance company. So the insurance company is charging you a simple interest rate, just like that HELOC, of let's just call it 5% in this example. And as you're doing that and paying the loan back, you're paying 5% to the insurance company on a declining balance when you're earning 6% or whatever your rate is on an increasing balance. One is going up, the other is going down. You're winning the whole time. This is one of the greatest untapped sources of capital that you need to learn about. Folks, I hope you've enjoyed this video. We've covered 5 untapped and some tapped sources of borrowing money. We've talked about good debt and bad debt in a roundabout way, and how you can turn the tides and use debt in your favor and take and recycle and recapture the money you're giving away to everybody else's bank and pay it back to your bank. And the 5th and final, I want to give you this. If you enjoyed this video and you want to learn more about that infinite banking concepts option, that specially designed whole life, then check this video out right here. Be your own bank. You will learn exactly how this works, and you'll learn how to get all the money back for every car you ever buy, drive, and own. Thanks for joining me for this episode. We'll see you on the next one.